Hi everyone, it's Jack back with another video, and today I'm going to be talking about Eastleigh Government Properties, which is a retail investment trust and one of my favourites, a company that I just recently invested in because it's had a pretty torrid year, down 36%, as many real estate investment funds are, because interest rates are rising. These are highly leveraged businesses and they come under some pressure perhaps, or tenants could have to default because they're in troubles. So many real estate investment trusts are coming at really attractive prices, and I think Eastleigh is extremely insulated in this because it only invests in government properties. Its only tenant is the US government, which has a pretty strong track record of paying its rents on time. It's down 36% this year, just above its 52-week low of 13.49, its 52-week high of 23.65. It pays a 7% yield right now, which is why I was really keen to lock this in at a reasonable price to FFO going forward, 11.38. Bear in mind that Realty Income, and another very popular REIT that I also really like, has a price to FFO of around 15, which I would consider a bit on the expensive side. I think this is much more reasonably valued, and is not really a business that ever becomes very cheap. It's currently sitting at a market cap of 1.35 billion. I think it has a lot of room to grow, and I'm going to tell you why. First up, just some crude graphs showing stock price, dividend payout and dividend yield. They only have data from 2016, but from 2016 to now, the stock is basically flat, although there's been a bit of a roller coaster in between, up above $22 at some point, but it's basically where it was in 2016. However, you'll have been picking up a 5 to 7% dividend yield in that time. It's been as low as 4.5% and as high as 7 as it is now. This is pretty much the all-time high for the dividend yield of this company, because its dividend payout has steadily increased over time from about 65 cents in 2016 to now around just over $1 as we speak. The success of this business and why the dividend has been able to increase is because they have a very strong strategy. They only target the US government, which is the largest employer in the world and the largest office tenant in the US. It's a highly fragmented market, but they're a keenly acquisitive company, and they have a couple of key tenants in a very high barrier to entry industry. They have minimum 10 years leases in key strategic areas. All buildings are less than 20 years old at the time of acquisition, and they focus on high building and construction quality. Government agencies are moving towards more lease-based inventory rather than government-owned. This has increased 23% since 1998, whereas a 1.1% decline for government-owned businesses, and it now rents more than it owns. They believe that given recent federal budget constraints, it's more likely that the US government will continue to grow its lease portfolio of assets. This is only going to be favourable to companies like Eastleigh Government Properties, and it is the only one of those businesses in the bottom right-hand corner that focuses solely on these federally leased real estate. This level of strategy and discipline is exactly what I want to see from a REIT, and is why Eastleigh has managed to develop an extremely strong portfolio in my opinion. They have 86 operating properties with a total square feet leased of 8.7 million, with a weighted average age of just 13.6 years, which is very impressive. Percentage leased of 99.3%, which is very, very impressive, particularly in the current high interest rate environment. Of course, that is the benefit of leasing to the federal government. They have 10.5 years weighted average remaining lease term, an annual lease income per lease square foot of $34.56, which is pretty impressive, not amazing, and an average building size of 101,000 square feet all across the United States, with a 63% of that being office space leased to a variety of agencies such as the DEA, which is why this company has the ticker symbol DEA. As I mentioned, as many REITs are, Eastleigh is highly acquisitive. Since its inception, Eastleigh has grown the portfolio from just 2.1 million leased square feet and 29 properties to its current size of 8.7 million and 86 operating properties. It has long-standing relationships with owners, developers and brokers, which is helping this in a high barrier to entry industry, because of course there is a significant vetting time, and dealing with the federal government is its own kettle of fish. They have identified a pipeline, and while acquisitions are down in recent years, they're still pretty strong quarter-over-quarter. They're purchasing 6 properties in Q4 2021, 4 properties in Q2 2022, they're adding properties at a slower rate than they used to, but they're still adding properties at a decent rate, and that was perhaps because in 2021 they just couldn't get the prices they were happy with the property prices being raised. Perhaps we'll see more acquisitive Eastleigh in the coming years. Eastleigh's own estimations see free cash flow going from $2.9 billion in the current portfolio today to, in 10 years, $5.7 billion, because there is stable, recurring cash flows backed by the full faith and credit of the US government in growing industries, and of course every year it increases with inflation plus a bit more negotiated into the contracts long term. Another thing I really admire Eastleigh for is identifying some lower quality properties which are weighing down the portfolio perhaps, or just cash that could be on the balance sheet, could be buying new properties, or could be paying down debt. They've identified a disposition portfolio of 10 properties with an average age of 14 years, lease percentage of 98.8, which is slightly lower than the rest of the Eastleigh portfolio, still majority leased to the government, that they want to dispose of, mainly because the lease square footage, the annual income per that is slightly lower than the rest of the portfolio, $31. So this is going to increase the average of the portfolio overall and generate some cash for perhaps paying down debt or buying properties in the future, while asset prices are relatively high right now, which I believe is an absolutely fine thing to do, and many REITs should do. It's kind of like rebalancing in a hedge fund portfolio or something like that. Overall, this is a business that I really like. I've just started out as my portfolio. I've been watching it for a long time, waiting for exactly this sort of drop to where it got to can't miss sort of prices. Price to FFO of 11 is not absolute bargain territory, but it's very low for this business. It's currently paying a 7% dividend yield, which I don't think I can really turn down, seeing as this company's tenant is the most reliable tenant across all of the REITs, in my opinion, being the US government. They're hardly likely to default on any of these buildings. This is pretty much as safe as houses. Bond-like dividend returns. The stock has been a bit all over the place. I can't see it dropping much more personally, but of course, I'm not a crystal ball. I don't have a crystal ball, so perhaps the stock will drop a bit further, but I'm not really concerned. I'm very happy to pick up that dividend in the meantime. I could even see some stock appreciation as this business bounces back in the future. And over the longer term, I think this will be a fantastic hold. One of those businesses that you can go to sleep very easily at night and retire on quite happily. Of course, I'm not a financial advisor. You should do your own research and due diligence, but definitely look into this one, perhaps add it to your watch list, do a bit more research on it and see what you think. But again, don't just do it because I said. Do your own research and due diligence, make your own decisions. Like and subscribe if you enjoyed the video, comment down below what you think of this business and some other REITs in the industry, and let me know in the comments below. I'll see you next time.